Monday, January 4th, 2021, Maneco 64, home of alternative economics and contrarian views. No, Billy is not going to reappear there out of thin air like magic. It's just that I did the video and I said 2020, right? That's always the danger in the beginning of the year. You get the year wrong. So I had to do another clip. So silver's leading the way. As the dollar starts the year on the back foot, we're seeing all the fiat currencies rallying versus the dollar. We're seeing fiat currencies dropping versus gold and silver. And the drops are bigger in gold and silver than in the fiat currencies. We're seeing all the other major commodities go up, like oil, copper, and all the other base metals. So not a good start for the year for the dollar, a continuation what we've seen in the last few months. We need to also look at the bond market, as the US Treasury has a lot of supply to unload this year. I spoke about that in my live stream yesterday. I'm going to talk about that a little bit today. And of course, we have everything else going on around the world. Some people expect 2021 to be better than 2020. I think they're going to be in for a shock. And the reason why I say that, first we have the hurdle in this coming week to go over in the States, political hurdle, of course. We've got the hurdle here in the UK where they're talking about having another full lockdown for months. I mean, how will the economy fare in such a situation? But anyway, let's look at the markets, because the markets are looking interesting. We'll look at the markets first, look at silver, look at the bond market and how that could be important for the overall financial markets. So it's 8:15 a.m. London time. So let's have a look here where we are. So right now we've got spot gold up almost $30, which is about 1.56%. Have you ever noticed that gold never goes up like 3 or 4%? It's always controlled, right? I would bet that they might cap it a little higher today, around 2%. Right now we're up 1.56, right near the highs. The low overnight has been 1891. Silver, though, is looking very good. We're going to look at a few charts here after we look at where we are. We're at 27.25, up 87 cents or 3.3%. So silver is definitely outperforming gold. So with that, let's quickly look at the gold-silver ratio. As you can see here, we're still holding key technical levels in terms of the gold-silver ratio. The lower this ratio goes, of course, that means silver is outperforming. And in a general bull market in precious metals and commodities, you want to see silver doing well, leading the way. I would say the key technical level to break right now is 69 in this gold-silver ratio. We're very near there. We're around 70, 72 or thereabouts, gold-silver ratio. So let's now look at a chart of silver itself. So this is a weekly chart. I had drawn this pennant on the chart. Pennants, of course, are consolidation formations. And this pennant has been going on for quite a while. Let's see, exactly from around the beginning of August when silver topped. Some thought the consolidation wouldn't last as long. I did as well at some point, but you can never tell with markets. But it looks now that we are breaking out of this triangle, so it's looking very good. There isn't really much resistance up until 30 now in silver. Of course, we're not going to go there in a straight line. It might not take that long, though, as long as it took for silver to come back. You know, in the last few months, we could see this in a matter of weeks, us reaching 30 or maybe even days, who knows. And of course, it's going to be up and down. Nothing goes up or down in a straight line, unless it's Bitcoin, of course. It's been going up in a straight line pretty much for the last 2 or 3 weeks. So yeah, Bitcoin, I guess, is a reflection, and the other cryptocurrencies now also start to move a bit, is a reflection of dollar weakness, but also I think it's a bit of a reflection of euphoria, both together, I would say. So that's the chart of silver. So a consolidation pattern means that usually the market, after a big move up or down, consolidates, and 3 out of 4 times after it breaks out of that pennant, it goes up and continues the previous trend before the consolidation. So the previous trend, of course, since March last year was up. So this is what we should expect. Of course, nothing in markets or in life is a certainty, but there's a good possibility here for silver. So now let's continue with the other markets. The stock market, of course, is continuing to do well here. The Dow is up 0.4%, the Dow future at 30,700. S&P is up the same, about 0.5%. NASDAQ 100 is up 0.5%. So the stock market doing the same. The FTSE, I saw a notice I got on my phone from my account that I use for my stock market investments, and it's actually the account I use to look at the prices, and it said, oh, FTSE up 1.3%, and right now it's up 1.6 at 65.90. But don't forget, about 20 years ago, or maybe more now, the FTSE was trading above this level. So the FTSE's had 2 decades of going nowhere, and the pound as well has dropped since then. So it's not a great situation, but of course the mainstream media looks at things very short term. So the currencies, we got sterling actually was up a little higher earlier this morning, but it's come back down. It's almost unchanged, cable. It's at 136.75, up about 11 pips. The euro, though, on the other hand, is up 0.5% at 122.69. The dollar is down almost 0.5% versus the yen at 102.86, and the dollar is getting crushed really versus the yuan here. It's down almost 1% at 644. So we've broken a really key technical level in the yuan at 650. I've been looking at that chart for a while of the dollar yuan. I had a target there from a double top at 650, but it looks like we've blown right through that target. And where could we go now? Well, the next target would be around 620, 625, I would say. So this is a really bad sign here for the dollar, that one of the biggest creditors of the West, that their currency is going up. What that tells me is that Chinese are unloading US dollars, in my opinion. So not great. What about the commodities? We got copper up 1.4% at 359. We've got WTI crude up 2.7% at almost 50 now. We're 49.57. So let's look at the bond market now, the 10-year yield, where that is, and talk a little bit about what I spoke about yesterday in the live stream about the heavy issuance that the U.S. Treasury needs to do this year, especially of Treasury securities that mature from 2 years to 10 years. And those are called notes. Anything less than 2 years is a bill, and anything more than 10 years is a bond. That's why they call the 30-year bond the long bond. But I think there is a 20-year bond that they issue now, but it's not very... they don't issue too much of that maturity. But this year they're going to have to issue net of what the Fed goes in and buys from the secondary market, because the Fed, of course, cannot buy directly from the Treasury. That would be basically blatant debt monetization. They are doing it, of course, through the back door. But net what the Fed will be buying from the secondary market, the U.S. Treasury has to issue over $2 trillion more of these 2 to 10 year notes. and possibly even more towards the 10-year. They do 7 and 10-year notes, or 5 years. Yes, net they're going to have to find investors to buy more than 2.2 trillion. We know that the Chinese are decreasing their reserves. We know foreigners are decreasing their reserves. I think dollars as a percentage of global reserves from other countries is dropped to like multi-year lows recently, around 60%. So what that will do, that will mean that the market will have to price in higher yields, and higher yields means lower prices for treasuries, and treasuries are held a lot by banks. So it could unsettle the whole financial market if interest rates rise. Of course, the bankers, the analysts, as I spoke yesterday about, there's an article in the FT from the 30th of December talking about that. They all seem to be okay. They say, you know, there will be a way. Yields will have to rise slightly to bring in buyers, but I'm not too sure. They could lose control, because if the dollar keeps dropping as it's dropping, you could spook investors even more, especially foreign investors. Goldman Sachs, they're talking about a trade in the bond market, in the treasury market, called a steepener. And what does that means is that they expect longer term yields to rise faster, or to rise more than the shorter term maturities. So that's a steepener. What you do there is you sell the long-term bonds and you buy the short-term bonds as the curve steepens. They expect that. They expect that to be a good trade. I don't know, that they could be right, and we're seeing that this morning already. Here we've got like the 10-year up about 2.5 basis points at 0.94, and we've got, for example, the 2-year note unchanged, so that's steepening there. We got the 30-year up 2.5 as well. But what we need to look beyond steepening or whatever is whether the Federal Reserve loses control of the bond market. If we start seeing yields spike not only up but also down, like it did back in March 2020, that's when troubles brewed in the financial system. We saw yields move as much as, I think, 50 basis points in a day, which is unheard of, except if you traded the Italian government bond market in the early 90s, like I did. The BTP, the 10-year BTP used to trade like that, but at the time it was at 10 or 11% yield. Right now we're below 1%. So that's what we need to keep an eye on. I would say a cocktail of disaster for the dollar. And you have to remember that, yes, the dollar is relatively weak versus the fiat currencies, but the fiat currencies will also weaken versus gold and silver. And eventually, not only the dollar will be under pressure, but all these fiat currencies. And I think that will be reflected in bond yields. And yeah, like the cocktail I was talking about, that will be a mixture of the stock market dropping, yields spiking higher, dollar weakness, and then commodities going up. That's what I think could be happening this year. There's a possibility of that scenario. Right now, we're still far away, as the bond markets seem to be under control for now. So we're seeing the dollar weaken, but we're also seeing the stock market remain pretty stable. So I will keep a hold of my pounds and dollars. And by that, I don't mean the fiat ones. I've got here 10 florins. A florin is 2 shillings. So that's 20 shillings up until 1914 or 19, I would say 1920 shillings was a pound. So there you go. These are pre-World War I coins. I've got 10 florins, which is the equivalent of 20 shillings or a pound. Of course, if you go back further, the real pound was 240 pennies, silver pennies. But we need to go a lot further back. Maybe one day I'll be able to accumulate 240 silver pennies. Those are difficult to come by and very expensive in fiat pounds these days. They measure, or they weigh 1.55 grams, I think, of silver. And I'm going to hold on to my dollars. Yes, not the imposter called the Federal Reserve note that says dollar on it, but the silver one, the constitutional one. Some people call it junk, but I think it's nicer to say constitutional silver. So I've got a dollar, a Morgan dollar. I've got a Kennedy half dollar. So that's $1.50 here. And I got two 1964 quarters. So that's $2 there. I'll hold on to them. Not only for 2021, but for the future. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Also think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Parler, Facebook, and all these other platforms below here. I wish you all a great start to the new year. Take care. Bye.